Hello and welcome to the annual review for the Intelsense Advisory for FY22. We had a decent year again. Last financial year, we were able to generate reasonably good returns. I think my focus has always been real absolute returns of capital, on the capital that we have, and a higher focus on our ability to manage risk, our ability to not lose our hard-earned capital, because I sort of have invested all my life like that. Money has always been sacred. Capital was not something which was very easy to get. So capital preservation has always remained the cornerstone of the way I think about investing. So I'm ready to forego a lot of very lucrative positions if I think that there is a possibility of a significant loss in those. Our long-term advisory has done about 29-30 odd % last year. Hitpicks, which is based on our Technofunda approach, has returned about 27%. Quant Q30, which is comprises of all market caps, so large cap, mid cap, small caps, that returned about 24%, largely because I think in the last half of the year there was a reasonable amount of correction in mid and small caps. Otherwise, actually Q30 was sort of outperforming most of the other strategies. Q10, which is a similar momentum strategy only for mid caps and large caps, that did much better. It sort of did 36%. Quiver, which is again a very concentrated small case only offering that we have, it has about 10 stocks, a very concentrated approach, uses quant as well as fundamental. We started about 10 months, and in the last 10 months it's up about 32%. Now for me that's a very good result, simply because the first 2 months of the year was actually very, very good, and that was a time when this was not around. So ideally, if it was there for the whole year, the performance would probably have been the best of all. The whole idea is that we focus on real returns, we focus on risk management, and that is what we've been trying to do for the last 3 years in the advisory. Now let's look at some numbers. For the long-term advisory, we've got currently 18 stocks. We added 5 new stocks during the year and sold 8. Out of the 8 that we sold, 7 we sold for profits, and 1 we had to cut losses. The one where we took a loss was the loss was 14%, and where we sold and took profits, the maximum gain that we had was about 500%, and the average gain that we had of all the stocks that we sold out was about 120%, roughly. Now these are averages of during the entire holding period. So if we held a stock for 2 years or 3 years or 1 year, this is over that time frame. The current ROC of the portfolio is roughly 20%, and the average debt to equity of the portfolio, excluding financials of course, because financials will tend to bloat up this number, is 0.33. So what you can obviously look at is that this is a very high quality portfolio with a high ROCE, low debt, very, very strong revenue growth and earnings growth, right? Revenue growth of 33%, earnings growth of nearly 45% across the portfolio. And what I also look for is high margin businesses, again, which demonstrates the quality of the business. So very high operating margin. Our long-term portfolio is across market caps. So it starts off from a small as small as a 2000 crore market cap and then goes to as much as a 5 lakh crore market cap. So it's truly market cap agnostic. So that's the story in numbers for the long term advisory. For Hitpicks, we recommended 26 stocks during the year. 14 of them were profitable. The best one was about 48%. The worst one where we took losses was about 18%. And the average duration that we held each of the stocks was about 2 months, 12 days. The maximum duration was 208 days, and minimum was 8 days. Obviously, when these are typical stop loss cases. So Hitpicks, I think the performance again dropped during the later half of the year, because when the markets started correcting, a lot of the stocks actually corrected and hit our stop losses. The benefit of a strategy like Hitpicks is you have very, very well defined stop losses which will take you out gradually from the market. So when actually, I think in January or February, when the markets corrected very sharply, Hitpicks was out of the positions probably the earliest, right? And that is not by design. In fact, there's no formula or algorithm that we use, unlike in quants, right? Here it is just that the positions were telling you that the markets are turning bad, and they were taking you out with roughly 8, 10, 12% stop losses. So the whole idea is you take small gain. You take small losses and you take larger gains. So that's the whole objective of doing Hitpicks. Roughly, the holding period of a stock is between 3 months to 4 months. That's the 2 months to 3 months. That's the average duration we hold a particular stock. So there is a reasonable amount of churn. The idea is to pick out stocks where we can get a quick play in their stock price. Moving to Q30, I think we recommended about 97 stocks over the period of the year. The best monthly performance was 9% up in a month. The worst monthly performance was 12.5% when the entire market was correcting. And the maximum drawdown, what that means is the highest point it reached to the lowest point it reached during the year was a 21% drawdown in Q30. Mind you, this is again a multi-cap portfolio. It has large cap, mid caps and small caps. And if you look at the performance in the last month, Q30 has been doing extremely well, simply because when it falls fast, because in a bull market, mid cap, small caps tend to have a higher proportion because they tend to move faster, and obviously when it falls, they fall faster as well. So the drawdowns are a bit sharper, but also the counter moves are equally sharp. So you got to take both in stride. So both the falls will be sharp and the rises will be sharp. Q10 also, during the year we had 59 recommendations. The best performance monthly was 11.5%, and the worst performance was minus 9%. The maximum drawdown here was about 24%. Again, very quick drawdowns and equally quick revivals is what we look what typically happens in a momentum system. Quiver again is a multi-strategy concentrated portfolio. This is available only on small case. Here we had 26 stocks during the year. The best monthly performance was 13% and the worst was minus 12%, with a maximum drawdown of 20%. So that's roughly all the advisories that we had this year in terms of numbers. just to give a some color on what we saw during the year, 2021-22 again was a year which was overshadowed by the COVID pandemic. I think middle of the year things turned extremely bad. Large numbers of people fell sick, needed oxygen. A lot of people died, and during, I think there was a period of a month and a half when I think everyone was focused solely on pretty much survival and helping their near and dear ones. I think that period of April and May was horrific for a lot of people. I think most of us lost either a friend or a family member or somebody we knew during that phase. So it was traumatic in many ways for a lot of us. At the end of the year, we've also seen a war between Russia and Ukraine. So the year has been turbulent, to say the least. Even during this period, I think India has done reasonably well. We've been able to. India is a very resilient country. That's what I tell, or that's what I think as well. We are a very resilient country. We're a set of resilient people, and I think a lot of it is because we have a lot of constraints, and constraints teach us to be resilient right from childhood. So despite so many problems globally and with COVID and things like that, I think people have done well. There's been a lot of hope. If you look at the economy, I think it started picking up. GDP growth has come back again. Direct tax growth has come back. India's tax to GDP has significantly gone up. That's probably a lot to do with the denominator, which is GDP, having shrunk in that period. But nevertheless, I think the tax collections have definitely improved. And I think another very important thing which happened during the year from an investment perspective is the long awaited divestment of Air India. Now, Air India is a very important marker in the entire divestment process, because this was something which was extremely difficult to do. A lot of pushback from organized unions, trade unions, huge amount of debt, lot of competition in the market, and then you are divesting at a time when globally airlines are stranded and not operating probably at very low capacity. So even with all that, the fact that this happened is actually a very good sign for possibilities for the future for other PSUs where they can get transferred to managements who are more focused on running it as a business and able to make it more sustainable and profitable. The other thing is obviously the amount of money that was going sort of to pay for the debts and the losses of Air India is now not going to be required for the government and the finance ministry. So that's sort of money that is being saved. So that's again a very important point that we need to think about. The market went up from 14,500 to 17,500 levels in the last in the financial year. And obviously if you look at the Nifty chart, the first half of the year there was a steady gradual rise, and then we've seen pretty much about 5-6 months now of a consolidation with a downward bias. A lot of new IPOs came to the market. We saw Paytm, Nykaa, Policy Bazaar, Manyavar, Adani Wilmar, and a lot more that I'm not missing out here. Lot of those companies came to the market, and some new businesses, business loss making newer business models that have come to the market. I am not a very strong proponent of investing in IPOs, because most of the time IPOs are overpriced. But what it does for us is it increases our basket of opportunities for the future. So over a period of next 3 years, 4 years later, you will have a much larger option of choosing from some of these companies once both the performance and the valuations stabilize. The other big trend that continued was newer investors coming directly into the equity market. So we saw a very large migration or large movement of people, especially from smaller towns and cities who have started investing into the Indian markets. In fact, I was reading a report somewhere that Bihar, MP, Rajasthan and UP have seen the highest growth in terms of the number of trading accounts that have been opened in the last 1.5 years. Which has, what all of this has done is, if you see the Indian institutional and Indian retail money that is coming into the markets is now able to successfully counter the FII influence. Previously, when FII sold, the markets used to just tank on those particular days. Nowadays, it's more or less able to counterbalance. Obviously, as and when selling happens continuously, consistently, there will be an impact on the market. But I think this is a very good, healthy trend for India, that we have more and more participants coming into the equity markets. Similarly, I think participation through secondary route like mutual funds, like insurance products have also gone up. What is really heartening to see is that SIPs as a mode of investment into the equity markets have gone from 8,000 crores to about 12,000 crores during the year. So now, previously the base used to be roughly 8,000 crores a month. Now it's closer to 12,000 crores, which is good, in terms of, again, the development, because SIPs tend to be more sticky in terms of input inflows and outflows from the market. People who are doing SIPs, they are not trying to get in and get out very quickly. So that bodes well for the Indian markets. And like I was saying, FIIs have been net sellers throughout the year, and significant amounts. The fact that we still were able to close the year higher than when we opened it is a testament to the fact that domestic liquidity has been significantly strong. So what is it that we are looking for in the year ahead? I think inflation will continue to be major concern. As individuals, we are seeing fuel prices have gone up. We're seeing food inflation happening, and commodity prices are going up. That has impact directly or indirectly in everything that we consume. Real estate prices are going up because cement, steel, all commodities have gone up. So everything is going to get impacted once inflation goes up, and the GDP growth will also sort of moderate because of inflation and because of other concerns. So it's going to be an interesting year, of course. I think last 2 years we've seen very, very strong returns from the equity markets. My sense is that we will have a more subdued kind of market in 2022. it will be range bound. There is some amount of valuation compression that is happening because the interest rates are likely to be headed higher. So I think that even during the year we will still have pockets of opportunity. Every market there are opportunities that are there, and the other important factor is that equities or investing in businesses is the only way by which we are able to beat inflation, by which we are able to get positive returns, right? Because if you look at fixed income, if I put my money in an FD, I'm actually losing my purchasing power, because an FD I will get 5.5-6%, whereas inflation, if I look at even CPI inflation or inflation which I can correlate for my own basket of commodities that I use, it will probably be close to 8-9%. So I'm actually losing purchasing power if I'm putting my money in fixed income. So businesses where they are able to pass on their cost inflation to the customer, where they are able to hold on to their pricing, are businesses which are likely to do reasonably better than others, and that's where we will continue to focus our attention in the coming year and coming years. Like always, the best way forward is to have low expectations. The secret of having a happy life is to have low expectations, and then get positively surprised. So that's what I think we should be doing for ourselves for this year. With that, I think with that we've come to the end of the review. Thank you for being a part of our journey, and please leave your comments and email me anything that your views, comments, and suggestions for this year. Thank you.